Well, as we mentioned, bank earnings season has officially begun. Both BMO and Scotia reporting results that fell short of estimates. Both banks setting aside more money for potentially bad loans as worries around the economy pick up. Let's get some more reaction to the numbers and a broader view on stocks. David Burrows joining us. He's president and chief investment strategist at Barometer Capital Management. Good morning.
Good morning.
Banks down this morning. BMO, Scotia putting aside more money for bad loans. Your reaction?
I think the bigger issue is both banks reported their expenses up more than expected. So if you get flat or down revenues and higher expenses, your operating leverage is not so good, and that has an impact. And that probably caused the miss for Scotia and also for BMO. I think also in the case of BMO, the guidance that they gave on the Bank of the West loan growth and deposit growth came in lower than expected. And so just some misses, and they're important. They did certainly take up their provisions a little bit, not a lot.
It is remarkable that given the uncertainty in the U.S. market, that right now having exposure to some of those regional banks sort of signals uncertainty. BMO was able to get that big deal done, and I think a lot of people thought this is a muscle they're going to be able to flex. But in the near term, obviously, there's a lot of lingering uncertainty.
Yeah, there definitely is a hangover for all of the banks, to do with that. But, as you saw in the case of Scotia, deposits were okay, not a problem. And that's the big concern in the U.S., I think.
So we've talked before about how, in your opinion, you've got these big players in the U.S. that can just get bigger. You've, liked J.P. Morgan in the past. The Canadian banks are already pretty big in this landscape and arguably are, fairly safe and sound compared to a lot of those U.S. regional players. How do you feel about investing in Canadian banks right now?
Well, we've stuck on both sides of the border with the largest banks. So our biggest bank holding would be Royal.
They report tomorrow.
Yeah, and we'll watch the expenses there as well. And of course, we have J.P. Morgan would be just about the same size holding. And both of them are benefiting from being the biggest and being the safest and getting great deposit growth and good returns from their investment businesses and so on. I think what will be interesting is if you look out over the course of the cycle, there will be growth in the net interest margins because slowly loans roll over and they have an opportunity to reprice them and gives them an opportunity to grow that. But it's not showing up right away. I think it's really important that we look at things that will do well as we get beyond the rate hike cycle, as the market starts to look beyond sort of slowdown and where the opportunities will lie there.
Let's talk a little bit about cycles because you've been pretty consistent in talking, especially with commodities, that we're entering into a phase that you see as a very bullish one for energy investors, for copper investors. Short term, this economic uncertainty has been weighing on those sectors.
No question.
What's your view?
Well, look, there's a lot of noise, right? We have some uncertainty around the reopening in China. That's an issue. We have this debt ceiling issue that's coming up, and lots of people are worried about that. I get lots of calls about that.
What are they asking you?
But in many ways, that's political theater because ultimately it will get resolved. But we have investors having spent the last 18 months trying to get defensive, and they've raised a ton of cash, $5.3 trillion in money market, lowest leverage in hedge funds in 20 years, significant hedging against S&P futures. And that's all for the now, right? There's a ton of money's gone into the defensive sectors like utilities and staples and REITs, and they've got nothing for it. They got no real positive results out of that. If we get to the other side of some of these concerns, those are not the things that are going to do well. So there are sectors and themes that are under-owned, where there's tight supply-demand, and any uptick going forward means a lot of leverage in earnings and a lot of potential growth as a size of market cap within the indices.
Already this hour, we had one view that because of some of those near-term uncertainties, there's nothing wrong with having money in fixed income. And I hear that from a lot of the strategists right now. But I'm listening to you, and I'm wondering if you feel that strategy over the next couple of years is one that you have to be pretty mobile with.
Yeah, I mean, we've had pretty perfect conditions for people to want to own defensive sectors and things that act like bonds, yet the bonds just broke out to higher yields, like on the 10 and the 30-year bond. And, you know, utilities have sold off hard over the last few weeks. I just think that inflation may be a little stickier. And some of the sectors that have an ability to deal with inflation, you know, are not well loved. People, the playbook is get defensive on those if there's concern about economic slowdown. But realistically, actually, commodity prices have been pretty resilient. They've come down, considering the veracity of the Fed hikes and the number of Fed hikes we've seen.
Yeah, and we'll see what the Fed and the Bank of Canada say next month. And we could talk all day about that. Before I let you go, one of the things, you know, I've covered technology for many years, and there is sizable momentum in that sector right now, whether it's because of AI, whether it's because they sold off. But that's not a new story. It's been this, and you've talked about this as well, there's been this comfort for investors over the last decade and leaning into tech.
Yeah.
Do you think those same factors are in play in here where there's a lot of stuff people haven't wanted to own, but they do want to own tech?
Yeah, they're definitely in play on the largest of large caps.
Okay.
Right? So all the returns in the S&P have come from the top 6 or 7 names in the NASDAQ, and they're great companies. If you look below that, breadth or the percent of stocks performing well underneath the surface has not been that good. So those are definitely seen as safe havens, strong balance sheets. A recession can be tough on Main Street, probably not going to be so tough on well-capitalized, big cap companies with an ability to raise capital whenever they want.
All right.